I think that this delay of reducing interest rates has just pushed global bond yields up, and we are certainly seizing this as an opportunity for investors to lock in interesting yields and to take more exposure to fixed income. This is one of the assets that we would certainly prefer in the current context. But also, there are a number of sectors that are currently benefiting from the overall context of still volatile inflation that is actually leading to the delay in Fed fund rate cuts. And in equities, for example, this would be the energy sector. The stock market, for sure, has been very much expecting that interest rates would come in 2024, not only from the part of the Federal Reserve, but really also from other central banks. And as a result, the performance year to date is very good. But the market expectations have already really changed a lot since the beginning of the year. At the beginning of 2024, it was indeed expected that the Federal Reserve might have to cut interest rates very deeply because there were also higher risks of recession. As these risks of recession gradually dissipated, then markets have already adjusted very much, and in most cases, they're expecting between one or slightly more interest rate cuts than that. So we believe that the Federal Reserve will be cutting interest rates 3 times by 0.25% in 2024. This is more than what is currently expected. And as a result, equity markets overall should feel well supported. In other markets, for example, in Switzerland, or as recently as this week in Sweden, central banks have already started cutting interest rates. So I do believe that we are going to see more and more central banks actually starting to loosen monetary conditions. In general, it certainly be a negative surprise if the Federal Reserve was not cutting interest rates at all. And even worse than that would be if the Federal Reserve might completely shift and actually think of raising interest rates. We would consider that as very unlikely in 2024, given everything that we are observing. But that would be a complete change for financial markets and would certainly weigh on the valuations of equities, especially in those sectors like communications or technology that tend to be interest rate sensitive, and therefore of which the valuations, which are among the more expensive ones on equity markets, would also be affected by it.